Of course, this is not financial advice and for entertainment purposes only.
Investors, welcome a guest who needs no introduction, Mr. Michael Khouw, the newest YieldMax strategist and a key spokesperson now for YieldMax ETFs. Now in this video, we're going to be discussing everything SLTY, everything ULTY, and everything in between, including to get to know more about Mr. Michael Khouw. So I'm going to throw it back to you, Michael, about how you're feeling about YieldMax right now and just how you're feeling about being on the channel.
Well, first of all, I really appreciate you having me. I'm excited to be here to talk about this. It's a pretty interesting time. As you point out, SLTY started trading yesterday. I think this is a really interesting development because now we've got a couple diversified funds that are looking to collect premium, and now it's kind of a pick your poison. If you're a market bull, there's something there for you, and maybe you're not as sanguine as people appear to be today. You've got SLTY on offer, so it's a good, basically, selection of offerings, something for everybody.
Let's kick it off with why did you join YieldMax, and what's your role specifically at YieldMax ETFs?
I'm obviously a long-time options trader. That's my background. I happen to be getting asked about MSTY in the context of MicroStrategy and Bitcoin. I'm a contributor on CNBC. They have this acronym challenge where the folks that are on CNBC get to talk about their, we'll call them their best picks or their most important themes for the upcoming year. And for the last couple, Bitcoin has been on my list. And so consequently, it's not uncommon for me to receive questions about Bitcoin and about MicroStrategy. MSTY being the largest YieldMax fund, and it has attracted considerable investment and has an embedded option strategy. People reached out to me to ask what my thoughts about it were. As I began to familiarize myself with it, pretty intrigued, and I started talking about it on a video one time. And it turns out that Mike Venuto and Jay Pastricelli happened to be watching. I think Scott Snyder might have been, and they reached out to me shortly thereafter and said, you seem to be familiar with options and you're familiar with what we're doing and wondering whether you might be interested in joining the team. So I flew out to New York when they were doing a bell ringing ceremony at the NASDAQ, which I believe you attended. That's sort of how it got started. So what's the role of the YieldMax strategist? I think there's two, but when it comes to strategy, one of the things we want to do is make sure we're kind of communicating with investors who might not be completely familiar with options or completely familiar with how YieldMax strategies employ them. Basically serve as a spokesperson, as an educator, and hopefully also get to collaborate with the investment team. So Mike Venuto is the CIO, Jay is the head of trading, Scott Snyder is sort of the head trader on a day-to-day basis. And if there's anything I'm able to contribute as a part of that process as well, and also on the new product side, I hope to. But my principal job is one, to be a communicator, I hope.
Let's talk about SLTY, which I'm super excited about, and I'm sure you are. So why did YieldMax launch SLTY, and what makes you super excited about the future of SLTY?
When I first joined, somebody had asked me, what's your favorite product? Do you like MSTY because I happen to have talked about that one, or NVIDIA or Tesla or Crash or any of the single stock strategies? One of the things that anybody who's an active market participant will know is that picking stocks is not an easy thing to do. So I like the diversified products, which is going to be the ULTYs, the YMAXs, which essentially take care of that part of it first, right? The natural selection of those stocks into those strategies is going to be the names that have high volatility, that are actively traded. In order really to be considered for YieldMax, is going to have to be in that realm. And generally speaking, that's going to be the most actively traded stocks that you're going to see anyway, just because that's where all the interest is, that those are the stocks that are moving around. They tend to be higher beta. The thing is that if you're trading a Chippy or an ULTY or a YMAX, one of these, they all have a bullish bias. Not everybody has a bullish bias. And so the great thing about SLTY is that, it's pretty innovative too, because there are not a lot of products that are focused on yield collection in options that have a more bearish tilt on the market. So it allows folks to make tactical bets while still trying to benefit from the strategy itself.
Can you go over the exact investment objective of SLTY and like a fund overview for investors who might not be familiar with ULTY and like how the inverse works with SLTY?
Yeah, well, first of all, I'm kind of glad that you framed the question that way, because I think an important thing for folks to realize is that SLTY isn't necessarily the opposite of ULTY, right? So let's talk about ULTY first. What you have is, well, first of all, a decent amount of flexibility with respect to strategy, which investors should hope for because there's an experienced trading team. A lot of these folks, head trader Scott Snyder, for example, these guys have been at this for a very long time. I started off as an options trader in the late 90s. Scott has been at this longer than I have, and he's supported by a great team. If you think about it, the most simple options trade there is, buy a stock, sell calls against it to collect a little bit of premium. What are you hoping for? You're hoping that the stock rises because you're long it, and you're looking to collect yield by selling options premium. In a product like ULTY or YieldMax, which is really an assemblage, if you will, of a lot of the single stock strategies that do this, you have a basket of stocks and you have effectively premium collecting strategies on each of these. The underpinning strategy in this case is going to be long stocks and collecting premium. SLTY, in as much as the reason I don't call it an inverse is because it's not like it holds exactly the opposite positions that ULTY does, but the investment objective, rather than being bullish, is going to be bearish now. So you have a collection of stocks with now a bearish directional tilt. So you can think of it as either being short the stock or synthetically short stock and collecting premium against it. So you can maintain your view with respect to premium collection, but you can alter your view with respect to market direction depending on where you happen to be. So this allows investors to essentially choose your own adventure, if you will. Not every trader is long all the time, and now you can essentially stay with the whole idea that you want to try to engage in an option strategy, particularly ones that are engaged in flexibly by people who know what they're doing. Alter your position slightly depending on how your sentiment with respect to the market changes from one moment to the next.
Now, will SLTY be a weekly income ETF or a monthly income ETF? I know that, for example, like MSTY is not monthly, it's like every 4 weeks. So I'm going to ask you how often the distributions will be for SLTY.
It is important for folks to recognize that there seems to be a real demand, really regular dividends. One of the things that the firm has done, sort of stagger a lot of these funds so that you have basically 4 different groups, and we have weekly distributions, but not always for the same underlying asset. In the case of ULTY, for example, unlike those other ones that are part of the staggered A, B, C, and D groups that are issuing monthly, but essentially there's a weekly distribution, just different funds are doing it. ULTY and the SLTY funds are weekly distributions, weekly payers.
What type of investor is SLTY for? Because a lot of investors have so many YieldMax products and they might not be familiar with how hedging works. So I'm going to throw it back to you on like what type of investor SLTY is for.
I was talking to somebody about this yesterday, and this is also important from the perspective of whether these products are inverses of each other or not. And because they're not, one thing one could do is you can blend something like SLTY with some of the other strategies to mute your delta. So for those who are not familiar with the term delta just has to do with the sensitivity of an option or an options portfolio to changes in the price of the underlying assets. So I'll give you an example. If we say something has a delta of 50, that basically means that its value will rise and fall at about half the rate of the change in the underlying asset. Most of the YieldMax products, including YieldMax and ULTY, but also all of the single stock products, have a bullish perspective. So if you combine something like that with SLTY, what you're really doing is you're mitigating that long delta perspective, but you're still in a trade that's looking to be positive carry, right? So I think that's kind of an important way to think about it. So, you can take a look at the stocks that are in it and say, I'm getting to lean a little bit short deltas in those, and I can, put that together with some of the places where I'm more bullish and still have positive premium collection as one of the investment objectives of all of the respective funds. When I was in the hedge fund business at Ivory back in the day in Los Angeles, we were long short, right? So what were we trying to accomplish? We would try to find stocks that we liked, that we wanted to be long, and we would try to find stocks that we didn't like as much, sometimes in the same space, but sometimes not. Therefore, try to profit based on our stock picking capabilities, but not necessarily on the volatility of the market, right? Because if you have a paired off book like that and the whole market rises or the whole market falls, the volatility of the underpinning of that whole portfolio is going to be reduced because you're not 100% long everything, if that makes sense. So I think that's a potential use case here.
What are the benefits of hedging with SLTY and even like the other YieldMax products? Like we have Crash, we have Winter, for example. We've seen like ULTY and MSTY share price decline just because the underlyings have gone down recently. And so some investors are wondering if it's like crucial include a hedging product like a Winter, like a SLTY, like a Crash.
Let's talk about share price declines and total returns. I think this is a really important concept because you will see share price declines, especially in funds where you have big distributions or in any underlying asset, frankly, where there are big distributions. If you take a look at the total returns for ULTY over the course of the last year, so going back to August 22nd, the total return for ULTY is about 25.6%. The share price is down about 49%. The difference is that you've just collected large distributions in the meantime, right? Now, if the underlying assets decline in value, if MicroStrategy goes down, MSTY will go down. If NVIDIA goes down, NVIDIA will go down. If the underpinning stocks in ULTY go down, ULTY itself will go down because key component of the strategies is that these are effectively buy rates. So you're long the underlying stocks. Now, if you are looking at something like SLTY, which has a more bearish tilt, you're mitigating the effect of a market downdraft. Now, will it mitigate it if it's a single stock or idiosyncratic events? Well, not necessarily, unless the holdings happen to correspond with the things that you have long. But if it's about the market in general, if you assemble a big enough group of stocks, and let's just say we were going to throw darts at a board, and you threw 250 darts at the S&P and said, every one that I hit, I'm going to be long, and every one that I didn't, I'm going to be short. Chances are that if you put on a portfolio that looked like that, it wouldn't exhibit very much volatility at all. So the real benefit of being able to hedge is that you sort of take that delta off the table. Now, I want to make an important point here because I was asked about this yesterday. If you are an investor with a long time horizon and something like that sounds appealing, you say to yourself, oh, well, I can take away equity market volatility. That sounds like a real positive. It can be in a tactical sense, but you're a young guy. As you save for your retirement and, future kids and their educations and things like this, stocks generally go up over time. While I think hedging on a tactical basis is important, I don't want people to feel like they should be taking all of their equity delta off the table all the time, because I think that's not what you want to have happen either.
I want to confirm that SLTY is not a perfect one-for-one hedge against ULTY. Is that correct?
Yeah, no, that is correct. Well, here's an important thing to think about, right? So let me give you a hypothetical example where I have two strategies in a generic stock. I'd like to say something like ABC or XYZ, but this is how we always used to use generic stocks. But let's just choose a generic stock. We'll say that the stock is trading for $100 and you want to engage in a buy rate. So if you do that, you buy the stock for $100. Maybe you sell a 105 strike call and you collect a few bucks for it. If you are going to have a bearish position where you're looking to collect premium, now maybe you are short the stock and you are selling some premium against that. Maybe you sell some downside puts, or another way that you could take a bearish tilt would be maybe you sell some upside call spreads. Now that position, which is short stock and short options, is bearish, and the buy rate is long stock and short options and bullish. But as you can see, they're not perfect inverses of one another, because both are short options on balance, because both are looking to collect options premiums over time. And here's another important thing. You wouldn't want them to be perfect inverses of each other either. Because if they were, it would be a little bit like buying long SPY and then buying a product that is short SPY. Why would anyone ever do that? You would just not buy it at all, right? So there's an objective embedded in the investment strategy of each of these, which is an attractive characteristic to people who invest in YieldMax products, which is to collect distributions, to collect premiums. And both of these intend to do that. It's just that one has more of a bearish tilt, one has more of a bullish tilt. You can use these two in conjunction with each other, or you can use each of these in conjunction with some of the other funds or your other investments to sort of tailor the exposure the way you want. That's the way I would think about it.
What do you anticipate the yield on SLTY to be?
So, making long-term predictions about what the yield is going to be is always difficult because it's a function of several things, not least of which is the implied volatility and the behavior of the underlying assets. So in low volatility environments, low implied volatility environments, the premium collection is probably going to be a little bit less. And in higher volatility environments is going to be a little bit higher. I would encourage people, though, to recognize that because you have a directional component, though, that doesn't necessarily mean that just because implied volatility is not as high as it ever was, that doesn't make things good. Consider what happened today. All of the bankers who are speaking at Jackson Hole, it looks like rate cuts might be back on the table again for the September FOMC, and equities rallied and volatility came in. The VIX is below 15, or it was, 14.4. So volatility is at a very low level relative to where it has been this year. Now, is that a bad thing for a buy right strategy, for example, for those strategies that are long? Well, stocks are up. The options that the funds were short have declined in value in terms of implied volatility, at least. So that's been good. When they're rolling these strategies, the premiums that you're going to be collecting on some of those calls might be a little bit lower than they would have been otherwise, and that's going to impact the distributions. But in general, for the long strategies, we like this. For the strategies that were like SLTY, to the extent that they might have been short delta, so short stock synthetically or otherwise, and short downside, you can take advantage of a rally like the one we're seeing today to buy some of that back at a lower vol. I mean, it's not in your favor because it was taking a bearish tilt on the market in general. But, if you're going to be opportunistic, you take what the market offers you and do the best you can with it. So people can gauge what these distributions are going to look like by taking a look at the implied volatility of the constituents, that is the members of these funds. And, most of these are going to be relatively high volatility. So in the immediate term, I expect the distributions are going to be quite strong as a result of that. And if we get an uptick in volatility, we're going to be selling more expensive options than we are now. So it'll be interesting to see. We're coming into a strong time of the year. So if we get through September, that's been the part that I've always thought was a little bit interesting because of the FOMC meeting. We might see kind of more of the same of what we've had this summer. But if rate cuts don't go the way the street wants, options premiums could jump.
We saw that SLTY was released at $50 per share. Some investors think it was too high. Why was it released at $50 per share? And can we see maybe in the future a reverse split this ETF of SLTY, given that the underlyings generally go up over time of stocks?
Well, first of all, I think it's important with any fund that makes material distributions. So if you're going to distribute all of your options premium and some of your gains as well, for whatever reason, you could see, price declines. And to your point, equities rise over time. So you could have a net effect on the price as a result of that. Some investors don't like to see reverse splits because they have a negative connotation. I don't think they really have a negative connotation in the fund case like this, because if the total returns are positive, folks shouldn't really care how many slices the pizza has been sliced into, because that's really all you're talking about. The higher price that it began trading at, simply means that you're less likely to get down into, prices that seem to concern folks. Now, I don't think they should be concerned about those. They're, like I said, because there's a negative connotation with reverse splits, we probably wouldn't do that until we're really obligated to do it, if that becomes necessary. I think people focus a little bit too much time and attention on that, because when you're thinking about it in a single stock context, I can understand why people would be concerned. But in this context, it doesn't really impact the strategy. It's not an example that the strategy isn't working the way it should, where it can be in the case of an individual company. If you see a reverse split, that's a good chance that it's indicating that it's not operating the way it should. Not the case here. So partially also going to be a regulatory thing, exchanges determinations about whether they want things trading at certain share prices. If something starts trading down to, very low single digits, then that's something that obviously everyone's going to have to examine when the time comes.
Just to confirm, so SLTY has the exact same underlyings as ULTY, or am I wrong?
These funds are what we call fully transparent. So you can actually go into these funds and see what's in them. So in terms of weighting, I'm just taking a look, a little over 5%. So I'm just going to look, I'm going to name the top 10, let's say, that are close to 5% on the ULTY side. So you have AST, Oklo, IonQ, Robinhood, AppLovin, Rocket Affirm, Nebius, Rigetti, and Upstart. So now if we go to SLTY, which is, of course, it just started trading, it's a much smaller fund at this point. MDB, Bill, ANF, Dell, GitLab, ALab, Crowd, Restoration Hardware. Does it match exactly? No, we have some MicroStrategy in here, Crowd, Intuit. I think this goes to the point you were making earlier also, which is that these things are not inverses of one another. The larger a fund gets and the more constituent stocks that it has, there's probably more of a likelihood that it's going to start tracking like one of the larger indices if they have many of these constituents in common. Individual positions may have idiosyncratic things going on that create some deviations. So the bigger these get in terms of constituents, the more they're going to behave like an index, but they're not replicants of each other and they're not the inverse of each other. So I don't think people should expect them to trade opposite to one another. I actually can imagine a scenario where both of these things could be up on the same day, or contrarily, both could be down on the same day because, like I said, they're not in opposite positions. Otherwise, they would track perfectly, but they would just be perfect inverse of each other.
Let's talk about ULTY, which I think is one of the most interesting cover call ETFs out there in the market. So I want to know, what are your honest thoughts on ULTY? Because the first cover call ETF till now, I don't think I've ever seen anything like ULTY.
Somebody asked me, what was my favorite product when I first started in ULTY is it. But if you take a look at the performance of ULTY and compare it to SPY, for example, on a total return basis, the S&P net of dividends total return over the last year, 17.44%. It's pretty good. ULTY's performance, you can think of it as long stocks, short calls against it. There's more operating flexibility. I think Jay has referred to this as the closest thing to, a hedge fund that YieldMax operates. It's not an easy thing to outperform the index, especially when you've seen some really choppy markets. I mean, what we had after Liberation Day in April was remarkable. The market sold off. The S&P, I think, was down close to 20% or something like that, peak to trough. And then we had one of the most remarkable V-bottoms that I've seen since I've been in the business. High single digits in a single day from the trough to the peak when the market rebounded that day. That's a really difficult environment to be short options premium. The team navigated that very well. And when I look at the various funds, this is the one that interests me the most because it has a natural diversification, because it has a lot of underlying assets in it. It has more operating flexibility in terms of options trading, which I also think is really important, because it is important for money managers to have a systematic approach. But there's a difference between having a systematic approach and a consistent investment objective and having a static strategy that is just strictly set and forget, because that's not what you want. And fortunately, ULTY has flexibility in this area.
What's your thoughts on the future of ULTY? Because so many investors, since I believe the prospectus changes in ULTY with a more stable NAV, with the distributions being super stable, going from monthly to weekly, some investors want to know your thoughts on the future of ULTY and if it could continue to outperform the market and I guess be sustainable long term.
Well, it definitely can be sustainable long term. And additional operating and investment flexibility with respect to strategy, enhances its longevity. the simple example I could provide is that if you had a completely static strategy where you could only trade one stock and you could only do one thing with it, which is buy the stock and then say sell a 1 week at the money call option on it, that strategy couldn't last forever, beholden to that stock. And if the market dynamics shift in a way that's unfavorable for that strategy, let's say grew and grew and grew, and suddenly you're outsizing the market, that could pose a problem. So you need to have some flexibility. You need to be able to adapt to changing market conditions and do what's right. And that's the beauty of ULTY, is that it has been able to increase that flexibility. And so you've got diversification, strategy flexibility. To my mind, if you're looking for something that can last, that's what's going to help. The other part of this, which you were talking about, which was NAV stability. The NAV stability question is something some investors focus on a little bit too much. If you continue to focus on total returns, the absolute price of the underlying asset and the NAV wouldn't concern you. An example, and think about it this way, banks don't concern themselves with it. When they issue a car loan after 60 months or whatever, they get their principal back, they get their interest. That's really what they're talking about. You could always reinvest your distributions and keep, your allocation to any one of these things stable. If you can use a drip strategy, for example. So take some portion of the distributions and reinvest them, assuming that the underlying assets aren't, moving wildly around. If the underlying stocks go to zero, which has nothing to do with us, but if something like that happens, that's going to end up affecting that. But investors can manage this, and the bigger the distributions are, the more flexibility they have. So ULTY has flexibility, investors do too, and I think they should use that flexibility.
Can you explain how the protective puts in ULTY work and how it aids to mitigate some large drawdowns in the underlyings of ULTY?
I have some friends who've done considerable quantitative research on individual stock behavior going into things like earnings. You can use things like protective puts around events, particularly if you think options maybe getting a little bit cheaper than they should on the downside. This is important. So you'll still have some risk to the downside, but you can mitigate a lot of it with strategically applied protective puts. So I think that's, really important. There's another aspect of this which probably doesn't get discussed that much, and impacts that funds can have on the price for options generally. So it also helps improve potentially liquidity. I'll give you an example. If I own stock and I sell some calls against it, for example, and that's all that I ever do, and I'm a huge market participant, then that can help create some resistance to upside movements in implied volatility. If I'm a two-way participant in the marketplace, so I'm buying puts in some cases, I'm selling call spreads, so I'm selling an at-the-money call and buying a further out-of-the-money one, it can improve the liquidity that's immediately available to the manager. And, it helps create a little bit less vol, and that could be a potential benefit. So for a host of reasons, I think it's important that there are times to be short options and there are times to own them. And, if you try to manage that intelligently, especially around, big market moving events, you can mute the volatility. And when you think about investment performance, risk adjusted performance is a really important consideration. That is to say, if you can mute the volatility of the underlying fund and still generate attractive returns, that's much better than if you generated the same returns with considerably higher volatility. I think anybody would agree that if you can mute the risk that you're taking and still generate attractive returns, that's what everybody's looking for.
Investors asked me to ask you if ULTY will have a reverse split in the future because they think that ULTY's holding super strong at $5 a share, $6 a share. And they also want to know if ULTY's NAV will be stable in the future. And I know that market conditions can vary, distributions vary.
It's clear that investors don't like the reverse splits, as I previously said. And as I also previously said, I think people are getting a little bit too concerned about that. Focus on your total returns. I can't say it's off the table because there might be a circumstance where, it does make sense. I mean, let's just say for the sake of argument, ULTY, which is trading around $5.75 right now, provided enormous distributions but traded down to $1 within the next 6 to 12 months. That has implications because it might just look unattractive as, as a single dollar stock or a single dollar ETF. So I can't say that it's completely off the table. Obviously, the investment team is going to have to decide what they want to do about that if we come to that. And like I said before, there are other considerations. We're trying to avoid those reverse splits simply because we know that they're unappealing to some as much as possible. I'm not going to say it's completely off the table. But remember what these funds are doing, and that is that they're trying to distribute as much as they can, as the name would imply, yield max. So if you're always making these big distributions and you're also giving people, for example, options premium, interest income, if and when and where you might get that, or some capital appreciation in instances where you have that as well, you put all of these things together, factor that in. So those things are going to end up having an impact. That's probably a decision that's going to be made by Mike Venuto and Jay and Scott if and when the time comes. NAV stability is, it is an objective, but it's not the objective. The objective is total returns and maximizing distributions. And, these other things are issues we deal with if we have to.
How is ULTY one of the most consistent and stable distributions ETF out of all the YieldMax lineup?
Well, the first thing I would say is that when you have a more diversified pool of underlying assets, it's going to be a little bit simpler. We've had some that have done really well because the underlying assets have done really well for a period of time. Khouw, I think, is a good example of this. Robinhood had a big rally, and it didn't work out so hot again because the underlying stock, MSTY, is at its core a buy right strategy I keep saying MicroStrategy, got to say strategy, because the company elected to change its name, but the stock fell. In fact, the stock actually wasn't tracking quite as well with Bitcoin as it has historically. Two things are going to happen, and that is that your NAV stability is not going to be there. And if the stock is going down in price and volatility is also coming in, which has actually happened in the case of strategy, you're not going to get the same consistent distribution. So the more diversified and stable the underpinning pool of assets are, the easier it's going to be to maintain distribution stability and NAV stability. So that's just a natural function, I think, of number one, strategy flexibility and diversification. And ULTY has that more so than some of the single stock, for example, YieldMax products do. And again, that's one of the reasons I really like it.
What's your thoughts on NAV erosion or NAV decline, NAV decay? And it's just been a term that's been thrown all around the street, whether it's not even just YieldMax, just the whole covered call ETF space.
Let's talk about decay, first of all, because that's a term that options traders use in a certain context. For an options trader, decay is what happens to an options value as time passes. And the Greek word that's often used to describe that sensitivity is theta. There are exchange-traded products that have derivative exposure that have negative decay. That is, that the value of the underpinning assets that the fund holds decline over time. So those are going to be strategies that have roll costs. So some futures exchange traded products where they have, whenever the market's in contango and the subsequent futures are higher than the ones that they currently hold, every time they roll, you end up with a little bit of decay. There have been some volatility related exchange traded products that experience this. And I'm not denigrating these things at all. If you buy options, decay is one of the things that you experience. So I would be hesitant to use decay to describe what happens to a declining NAV in YieldMax case, though, because YieldMax products are selling options, not buying them. The underlying funds are going to generally be collecting premium, not paying it. So decay is actually a tailwind for the YieldMax strategies, where it might not be for some of those other exchange traded products. And again, this is not to denigrate those products at all. Everything has its place. People who are looking to make tactical bets on a big spike in VIX might want to trade an exchange traded product that gives them long exposure to it. And maybe they can't trade VIX futures. Maybe they can't trade options on VIX futures. And so an exchange traded product that trades a lot like a stock makes good sense to them. I wouldn't encourage people to just buy and hold those things forever. And that's because they collect decay. These are investment products. By contrast, the YieldMax products are investment products that intend to collect decay. So decay and NAV erosion are not the same thing. NAV erosion, by the way, is what happens to the residual value of a fund as a function of the changes in the security prices that it holds, also the distributions. So if you put $100 into a product and you get a $7 distribution, and after you get that $7 distribution a month later, let's say that the net asset value per share is $98. Well, that was a huge win because net you made 5% in a month on your investment. If all you're focusing on is the NAV and you're saying, well, now it's 98, you still made 5% on your initial 100. So your total return on your $100 investment was 60% annualized in that case. That's a good outcome. And that's why I think people focus a little bit too much on the NAV. But I also understand, and I'm hearing this increasingly, people say, why can't it just be like the par value of a bond, where there's just one number and maybe the payments and the distributions float. And there's a balance to be struck there. But I would also caution investors on this, and that is that you need to think about your total returns also on things like a tax basis, right? We want to make sure that people get the highest possible distributions, but we also want to make sure that they receive those distributions in a manner that's going to be as tax efficient as we can potentially make it. And that has implications as well, both to how the distributions themselves are described and if and when we make them. So to minimize that, nobody wants to get a big tax headache that is unnecessary. Of course, taxes are inevitable. You can try to minimize their impact. And, we're going to try to do that. And all of the interplay of all of those things is going to have implications for the NAV. It's going to have implications for how distributions are described. And I think it's really important for investors to recognize that. You have to be careful what you wish for. What you should wish for is the best risk-adjusted total rates of return that you can get net of taxes. If you handle that part well, a lot of the other stuff is kind of the noise that maybe deserves a little less time and attention, if I could say that.
What are your thoughts on the term return of capital? Because I've noticed that most, if not all, YieldMax products are mostly described as return of capital for the distributions.
Right. So return of capital, when a distribution goes out and the characterization of that distribution is return of capital, the first thing people need to recognize is that's an estimate. You will not know for sure until the end of the applicable year how the whole thing shakes out. But I will say this: there is a tax implication, but it is generally an attractive way to take a distribution, all else equal, and it's a characterization of a distribution. You can have a fund, and that fund can have a lot of things going on inside of it. It could have interest income. It could have earned options premium in it. It could have realized and unrealized short and long-term capital gains. Then you make a distribution out of that fund. How that gets characterized, and by the way, you're also dealing with different regulatory bodies. So you have the SEC, you've got the IRS. If you get a distribution, and I'm not providing tax advice, see your accountant or your tax attorney. But I will say this: if you get a return of capital, that's how a fund's distribution is characterized. That doesn't have an immediate tax implication for the recipient of the distribution. It lowers the basis of the fund itself. Again, here's an example. I invest in a fund. I buy it $100 worth of it. The total return at the end of some period of time is 5%, so it's worth 105, and I get a distribution of 5%. If it is characterized as something that could be taxed as income, that has implications. I live in California, that has very big implications. If it's characterized actually in California, unfortunately for me, as a capital gain, that too is treated as income. So I'd rather that not happen. I would much rather get a distribution for $5 that's characterized as return of capital, because that won't be taxable, and my basis in the shares will go down by 5. So I had a $100 basis, now it's 95. But that implication is only going to be realized by me as a taxpayer if and when I sell the underpinning shares. So if I put 100 in and I took 100 out, that would reduce my base, and all of it was characterized as a return of capital. The basis in my shares, whatever they're currently worth, is now 0. So if it was $100 when I invested and they're 100 now, and I've taken 100 in distributions, in Misty's case, people who bought Misty, if you bought it on the first day, you've taken more in distributions than it was originally worth. You can't get a return of capital technically from a tax perspective such that it's greater than what you initially invested. So your basis hit zero, and then everything thereafter, you can't really characterize it that way. But if and when you can, it's probably better for most shareholders. Now, look, there's going to be investors who are invested in these things in tax-deferred, untaxable accounts. Like, so if you have a Roth IRA and you have these things in a self-directed Roth, when you eventually redeem from that, there isn't a tax implication at all. But a lot of investors do have tax implications. I would venture that probably most of the people that are watching this video, taxes matter. So before people get a little bit too caught up, just think about how distributions, how you hope they're going to be characterized. We're trying to do the best thing that we can to deliver the yield and the distributions and the returns in the most tax efficient manner possible. We and all managers, this is not unique to YieldMax. And then, of course, you do that within whatever the guidelines and the regulations are by the respective bodies that are doing that. So, again, not tax advice, but return of capital, it's a characterization of a distribution. Sometimes people think of it as a negative connotation, but it does not necessarily mean that you're handing money to a manager and they're just giving it right back to you.
Are YieldMax ETFs designed to always reinvest the distribution?
Yeah, that's a question actually that's more specific to the investor, because this really ties to their objectives and needs. We have SLTY today and yesterday. We didn't have this a week ago. So if you only lived in a world where YieldMax products were the things available to you, that's not the world we live in. But if it was, it would not even be as simple as saying, okay, I'm going to take distributions from ULTY and only reinvest them in ULTY. If I elected to reinvest them, or some portion of them, if I like the underpinning strategy, my objective would probably be to keep the amount of my exposure to that investment at roughly the same percentage that I'd initially allocated. I'll give you an example. If I have $1 million account, 5% of that account allocated to ULTY, I'm going to invest $50,000 in ULTY. I'm going to get a distribution. If the value of my ULTY holdings has now declined to, say, 4%, I'm going to take additional monies to get it back to 5%. If, we get material appreciation in the underpinning shares, and I also take a big distribution, and now I'm over-allocated, when I get those distributions, maybe I don't reinvest it into that. This is really context dependent. Folks are going to have portfolios, and you're going to say, I want to have a certain amount of that exposed to high dividend payers, high distribution investments, and maybe you have some other speculative investments. And then as the value of these things go up and down, people typically will rebalance. That's what most professional fund managers do. They have allocation techniques. They say, we want to have 5% allocated to gold. We want to have 5% in Bitcoin. We want to have, 20 to 25% in fixed income investments, like, some sort of bonds or something like that. We want to have a certain amount of S&P exposure, and we want to have a couple, high distribution or high dividend paying investments as well. And as all of those rise and fall, you try to keep the allocations to each one of them consistent. So when you receive distributions from one, depending on how those others have done, that helps you make a determination about whether you're going to, using a drip technique, decide that you're going to reapply some of that distribution to that asset or to a different one, just so that you maintain that balance.
Speaking about a recession or like a stock market crash, stock market pullback, how do you view YieldMax ETFs to perform during that type of market condition? Because so many investors have experienced, we've experienced a good bull market since basically the launch of YieldMax ETFs. And maybe some investors just want to know from your point of view, like, how will these products fare in a huge market pullback that is maybe more than April? But I know that so many competitors do cover calls, but they are on leverage, whether it be 150%, 200% of the share price of the underlying. But YieldMax ETFs doesn't have any leverage, to my knowledge, on any of their products. So
yeah, the levered products, leverage can be a powerful tool, but it cuts both ways. People should be aware of this. The performance of something like SLTY, which has a net bearish tilt, is obviously going to be better than ULTY, which has a net bullish tilt typically, or YMAX, or any of the single stock buy right strategies. Those are typically going to go down. Not typically, they will go down. I mean, if you're long stocks and you sell covered calls against it, a market decline is not what you're rooting for. If you're long stocks, you want the stock market to go up. You want your stock holdings to go up. I think there's a perception that because you're selling upside calls, sometimes people think, oh, well, I kind of want it to go up. No, you want it to go up. You own the stocks. If you sell an upside call, have you limited your potential gains? Yes, but think about it this way. If you've sold puts, what do you want the underlying asset to do? You want it to go higher. Inverse situation where stocks go down is going to be bad for positions that are net long stocks. So, that's a long-winded way of saying, you're rooting for this in most YieldMax strategies, not SLTY necessarily, but most YieldMax strategies, that's what you want. You want the underlying stocks to rise because you have net long exposure to them. I would actually throw this in, and this is not just related to YieldMax, but this is just a general observation. We want the economy to do well. We want stocks to do well. Not everything that everybody holds is going to be in YieldMax funds. You probably have 401ks. What are they? They're long stocks. You work for publicly traded companies. You receive stock as a percentage of your compensation. You want these things to go up. Stocks go up when things are going well. That's what we should always be rooting for. And I've gone through a couple bear markets. They never feel good. Even if you thought the market was overpriced before they did, they don't feel good. We want markets to go higher. They won't always. That's the painful part of investing, but that's what we're rooting for generally.
Do you think that YieldMax ETFs will be around in 5-10 years? And how do you envision the future of YieldMax ETFs down the line?
I fully expect it to be around. And here's something to think about. This is early days for options-related strategies within ETFs. I'm going to use round numbers, and I'm probably underestimating. But let's just say that ETFs have 14 to 15 trillion in them in round numbers. And let's say that options-based ETFs are about 1% of that number, maybe 150 billion. A meaningful percentage of that is in YieldMax products. But that's 1% of ETFs. And ETFs as an asset class are growing relative to the equity markets. And options are growing relative to the ETF market. So this trend is definitely growing. It's not shrinking. And it makes sense because options have nonlinear payoffs. Nonlinear payoffs are and also not perfectly correlated, right? So people want to see other sources of returns than simply being long the S&P 500, or at least some do. More sophisticated investors, they need to diversify their investments. They're going to have an interest in this. So I expect a massive proliferation in options-based strategies. Consider, too, that as ETFs have grown so tremendously relative to mutual funds, options growth, volume growth, has outpaced equity volumes by basically exponential amounts over the course of the last 20 years. So there's a lot of room for options-based ETFs to catch up to what the options market itself has been doing. And I fully expect that. And I also think that there's a reflexive element to this, which is that as more of these ETFs do trade options and people recognize their benefits, that the options volumes themselves are going to increase, and it's a self-fulfilling kind of a thing, I guess.
What are some tips you have for investors that are not financial advice? So this is not financial advice, but some tips for investors who are thinking about choosing a YieldMax ETF. Maybe it's ULTY, maybe it's SLTY, maybe it's MSTY, and they just want to get the best returns possible.
The first thing I would say is that if you're looking at, whether it's YieldMax products or anything like this for the first time, first of all, make sure that the underpinning assets adhere to your thesis and keep it simple. MSTY, an interesting product because Bitcoin has been a volatile asset. MicroStrategy has been a more volatile asset because it's kind of a levered play. Obviously, it's turned out very well. But the thing is that if you're an investor who's just looking at this and you don't have a view on Bitcoin, or maybe you already have exposure to Bitcoin and you're interested in YieldMax strategies, but you say, I'm already invested in Bitcoin, so I don't need to do MSTY necessarily. Use a diversified product. Like I said, use something like ULTY, which has the flexibility to engage in other types of option strategies. So you've taken the stock picking element out of it, which for people who are new to the space, that's probably a benefit. You're taking advantage of the fact that they can trade tactically and hedge. That is also probably a benefit. Simpler, more diversified, more flexible. If I was going to put the first dollar in, that's where I would do it. It's interesting because actually the first dollar I put into YieldMax Strategies myself was in fact into MSTY. This before I joined. I was on or about the time that I happened to be talking about it. But, I am a Bitcoin bull, and I think Michael Saylor's activities over at Strategy are pretty innovative. Again, not financial advice, but the simple thing is keep it simple. Diversify.
Do you have any final words for investors who are investing in YieldMax ETFs? Because I know you're going to be probably like the next face of YieldMax, because I know we might see less of Jay and more of you, Mike. So I know so many people have a lot of money in ULTY, a lot of money in MSTY. We're seeing the inflows just go up. It's almost like every single day. So people just want to hear from you on any final takeaways, anything you want to tell them about their investment in ULTY and SLTY and MSTY and maybe the future shareholders of YieldMax.
My hope in all of this is that, my participation with the YieldMax suite of products is going to, increase the communication and transparency that's available to shareholders without taking, more of Jay's time away from actively managing, the strategies themselves, continuing to innovate. You're definitely going to hear a lot more from Jay and Mike Venuto and Scott Snyder. As you point out, these things have grown a lot. And as they've grown and as the need to communicate with investors has increased, there needed to be more people around who are available to do it. There's just a lot of people to talk to, and there's still a lot of work to be done managing the strategies themselves. And so hopefully this just increases the bandwidth of the team to have me added to it. At least that's what I hope. And I think the future looks pretty bright.
Thank you so much, Mr. Michael Khouw, the newest YieldMax strategist, as well as a key spokesperson of YieldMax ETFs. Now, if you guys like this video, please give it a like because this Khouw puppy did. And go ahead and check out our last interview with Mr. Jay Petrocelli that just hit over 100,000 plus views about everything MSTY and even ULTY. I love you guys so much. Crush it in the stock market. And take it easy. Peace.